So as Jim said, what I would like to do is to talk about two topics. The first one is crypto. And the second one is, if you like, the main part of the presentation, which is what you see on the title page, which is on central bank digital currencies, and how they might fit into the future monetary system. We wrote a chapter in our annual economic report this year, back in June, laying out some key building blocks. But I think it's fair to say that since then, many of these issues have become even more topical, especially the events in the crypto world. So if I just start with that topic, it's worth knowing that, just mentioning, just for the sake of being on the same page, that although crypto operates under the banner of decentralization, the ecosystem itself really has a very important role for centralized intermediaries. And I think what we've seen, I mean, you mentioned FTX, Jim, but FTX is one of those centralized intermediaries. The way that users gained access to the crypto universe is by holding accounts at FTX, and it's a very standard, architecture that we're all familiar, when we have a bank account. And it's also, I think, important to say that these centralized intermediaries, they've been very important because they have been the main channels through which mainstream investors have gained access to the crypto world. And so here are some company logos of some crypto firms that have encountered difficulty, shall we say, recently. And there are many themes that are familiar from the great financial crisis, the 2008 crisis, that have to do with leverage, that have to do with maturity mismatch, runs, and so on. And the ecosystem really does, I think, highlight that the problems have really arisen in that part of the system that has grown very large, and the themes there are really quite familiar themes. They're not actually themes that are crypto specific. Now, within this ecosystem, stable coins have come to occupy a really very central place. And the reason for this, I think, is also very revealing, because what it shows is that stable coins play the role of the point of contact, if you like, between the crypto universe and the conventional monetary system. And the primary function has really been to piggyback on the monetary unit, to piggyback on the unit of account role of conventional money, and therefore play this role as the connecting point between the conventional monetary system and the crypto world. Now, in this chart, we're seeing the market capitalization of some of the biggest stable coins. And you see that in May, that purple part just disappears. I mean, that is the Terra stable coin, which of course blew up back in May. The black line is tracing out the total value locked in DeFi, in decentralized finance, and I'll get to this shortly. But it's the growth of these stable coins that have really enabled access to the crypto universe, which tended to be, I think, a very narrow, very specialized niche occupied by enthusiasts that were running custody. They were running custody of their own coins by managing their private key, a self-custody system, if you like, or even playing the role of a node in the Bitcoin blockchain even. But the combination of exchanges and stable coins have really opened up this universe to mainstream finance. Now, what about the pure version of crypto as such, where there is decentralization of the operation of the blockchain itself? So whether it be proof of work or proof of stake, certainly some elements of crypto do incorporate this decentralization element. Having said that, it's turned out, and I think subsequent events have also proved this, that even these notionally decentralized blockchains, many of them turn out to be decentralized in name only. They're actually quite centralized. And a good example is the Terra blockchain, and that's the blue circle there with the red outline. The Terra stablecoin, which blew up in May. You know, when that blockchain went down, I don't think people were searching around for the group who were running it. I think they were quite focused on the founder, and quite rightly so, because the control was highly centralized. And that kind of image is really quite pervasive in crypto. So yes, notionally some of this is decentralized, but a lot of it turns out to be quite centralized, even in spite of the name. So there is a debate out there, and some soul searching as well, about whether crypto should go back to its true decentralized roots. So should it go back to a pure form of crypto, maybe back to Bitcoin in 2010, 2011, when enthusiasts were indeed running nodes in the Bitcoin blockchain and self-custodying their coins. I mean, that's certainly one way to think about this, and I think some of the soul searching that we've seen after the recent turmoil has put up this idea that it's important to go back to roots, go back to the true nature of DeFi, true nature of crypto, and find again its roots in decentralization. Now that's all fair and good, and I think there is something to be said for communities of enthusiasts who are running these systems. I think some people might view them as being somewhat eccentric. It's a very could be a very eccentric hobby maybe, but it's very different from what we've seen more recently, which is that as crypto has gone mainstream, it really has entered our living rooms through, there was the sort of Super Bowl ads telling people how easy it was to get into crypto. And so, going back to the true roots of crypto, maybe one way of, as it were, rectifying or, purifying, if you like. But to be sure, what that means is that this kind of mainstream adoption, and in particular selling coins to retail investors, is not something that's really compatible with that previous pure version of crypto. Yeah, to get into that activity, you would need to know how to run a node. You would need to know how to do the proof of stake. You would need to know about all these technical issues, which used to be the preserve of these very, very specialized people. Now, but there could be service providers who come along and provide so-called unhosted wallets, and that may be one way that you could actually get into the activity. But to be sure, it's going to be a very, very small part of the mainstream financial system, and I think the barriers between the crypto world and the mainstream financial system is going to be, quite high. And the other point is, even if we take for granted that the true, pure, decentralized version of crypto is untainted by the problems that we've seen recently, with the failure of FTX and the associated failures. I think it's also fair to point out that the way that crypto works, if you like, the burden that decentralization places on the need to sustain the consensus mechanism does lead to high rents, congestion, and as a consequence, the fragmentation of the system. Now, what do I mean by this? What this chart shows you is the gas fees on the Ethereum blockchain as a function of the number of transactions. And the way that proof of work works is that miners are solving problems in a competitive manner. If you win the competition to solve the puzzle first, then you have the right to attach the block to the longest chain. Proof of stake would have that selection based on on your holdings of the underlying coins. But what that means is that insider rents are really a very important part of the system to actually work in a sustainable way. And that's because you need to give incentives for the miners or the validators in a proof of stake system to actually play their role in the validation process. And that means that having some congestion, having some limit to the capacity is really essential, because otherwise there would be no cost, there would be no rents to generate, and the miners or the other validators in a proof of stake system would find it very difficult to make it worth their while. Now, that does mean that when activity is high, the cost of using the blockchain is also high. And we see this very sharp increase at the end of the chart here, where once you reach capacity, you need to really pay a lot to actually get your transaction validated. Now, what that means is, unlike a conventional monetary system, and a conventional monetary system has a very natural network effect, where the more other people use that network, the more you want to use that network as well. There is a very important coordination element here. So the more the merrier, if you like. But if you have this very hard capacity constraint, which is necessary to generate rents, what you have is not strategic complementarities, but rather strategic substitutes. So the more people use a particular platform, the higher is the cost, and therefore the less is your incentive to join and use that system. And this is a chart that's meant to illustrate that point, that congestion leads to fragmentation and a move away from one standard emerging as the dominant standard. What this chart shows you is the total value locked in the underlying blockchain of a number of well-known so-called layer one networks. So the underlying blockchains that actually process the transactions and is the arbiter of the truth of the events that actually happen in that in that universe. The black line also includes so-called layer twos, which form bridges and have overlays on top. But what you see is that in the early days, and this is just going back 2 years, Ethereum was really the dominant layer one. That's the light blue. But what you see is that as activity increases, so in the post-pandemic, boom in crypto, you see this increase in activity, total value locked goes up, and then you see this fragmentation of the system. New layer ones come in. And this is exactly what I was referring to earlier. As costs go up, and remember, congestion is a feature, not a bug, because what you need is to give sufficient rents to the insiders so that they can be given incentives to perform their role. And as costs go up, new entrants enter the system. Sometimes they have bigger capacity. Many of them are quite centralized. And the red here is, of course, the Terra blockchain, the one that blew up in May. And you see that very sharp decrease in May as many of these lines come down. And it's been relatively subdued. So I think the argument that I'm trying to put forward here is going back to, if you like, the classical notion, the pure version of crypto, which is decentralized. That may have some merit, but what that means is it's going back to a very different crypto universe. It's not something that is open to retail investors, that is bringing in new users. It's going to be a very small part of the of the economy. And in general, even that is going to suffer from this kind of structural flaw. The fragmentation really renders these systems unsuitable as a monetary system. I mean, money is the coordination device that we know best. So we all use money because other people use money. And for that network effect to really take hold, we need this strategic complementarity. Crypto just doesn't give you that. So even in that pure decentralization case, we're not going to get there. I think what has really transpired is that the price action, the fact that the whole system is sustained by selling coins, it does mean that we have these cycles where as the price increases, we have new users who come in. But as prices fall and as new users dwindle, the system really takes backward steps. So here is the chart of the annual change in the price of Ether, the coin behind Ethereum, and the number of new DeFi addresses. We actually published a working paper recently that actually looked at the number of users who downloaded crypto exchange apps. And we did some analysis, which shows, I think, relatively clearly. So the left-hand panel shows that the active data users of crypto exchange apps really follows the outline of the crypto price itself. So here, in this case, it's just the Bitcoin price. And what this means is that, of course, most of the people who downloaded these apps did so at the peak of, or near the peak of the crypto boom last year. So on the right-hand panel, it's giving you a sense of, at what price of Bitcoin did most of these users actually download these apps for the first time. The dotted line here refers to $20,000. Bitcoin is now a little bit lower than that. It's more like 17,000. And so even the blue bars on the left, which is the number of people who actually are still, ahead. I mean, that's dwindling further. It's also worth saying that Bitcoin, comparatively speaking, it is the more sort of resilient. It's the kind of blue chip coin. In that respect, I mean, some Twitter users would even claim that Bitcoin is not crypto, and I don't want to go down into that, into that debate. But the point is that price action, the fact that you have to sustain this kind of system by selling coins, means that it's something that is very, very sensitive to the price action itself. Now we have a better alternative, and so let me just change gears. I want to move to the chapter material that we presented in our annual economic report. What we want to do, and this is something that we sort of laid out in some detail in the chapter, is to think of the future monetary system as something that preserves, if you like, the fundamentals of the current system, in that it's a system that is rooted in central bank money. And in this respect, so for this reason, we use the metaphor of a tree to convey the idea that everything is rooted in central bank money. But we can think of quite an elaborate and really a very versatile and powerful set of functions that we can build on top. Now, the key point here is that the system doesn't run by selling coins. It doesn't need to be sustained by selling coins. It's just like the current system that we have. And here the central bank is going to play a foundational role, but the most important role is going to be played by the private sector. So just like today, where most money in the system is private money, it's the liability of the private sector, mainly bank deposits. We can still envisage that basic architecture where the central bank, through its supply of central bank money, provides, the whole system is rooted in central bank money. It is the trunk of the tree, as it were. But the consumer-facing activities will be done primarily by the private sector payment service providers. And so, this is a more general term that encompasses both commercial banks who issue money in the form of deposits, but also other non-bank payment service providers. And within that ecosystem, we can think of a central bank digital currency. In the variety which is accessed by the payment service providers, there is a classification here. We call the central bank digital currencies that are accessible to the payment service providers only as wholesale CBDCs. They're rather like central bank reserves currently. So it's only the commercial banks who have access to central bank reserves. That's the idea. So wholesale CBDCs are a digital version of central bank reserves, essentially. And the interesting questions really come on how to put the whole system together. And let me spend a little bit of time on laying out some of the alternatives here. Now, one of the virtues of going this way is that we can, without going very far, incorporate some of the features that are well known in crypto. So in particular, this idea of programmability. So the idea is that you can take contingent actions, bundle them together, and execute a set of actions together simultaneously, just as you would do in a simultaneous action game. So the idea would be, well, we can actually implement an equilibrium, even though it may not be a subgame perfect equilibrium. If you can actually commit to something and commit to a contingent action, you can just bundle them together and execute them, as a bundle. A very a good example of this is payment versus payment, or payment versus delivery in the securities market. So, one of the issues that we talked about in the latest version of the BIS quarterly review is the idea that in foreign exchange markets, typically, there'll be a need to exchange currency. So, I want dollars and I will provide, let's say, Brazilian real. Now, you will use intermediaries for that. And then the sequencing will matter for counterparty risk. There was that very famous case in 1974, which is called Herstatt, the Herstatt case, where there was a bank that actually had paid its part, but before it could receive the payment, before it could receive the currency that it had paid for, there was a glitch, and because of counterparty risk, this had huge implications. That's exactly the kind of example where if you could have programmability built in and execute contingent execute contingent actions together simultaneously, then you can overcome these these problems to do with counterparty risk. So that's a very, very simple example. Of course, you can do this with centralized intermediaries as well. You can do it through a central counterparty, for example. And in the foreign exchange market, there is this international utility called CLS. It's a bank, but it really plays a very key role. But CLS doesn't have all the world's currencies as as CLS currencies, and so there is still a large amount of trading, 1/3 we think, which is still subject to this kind of counterparty risk. That's the kind of thing we can easily address. Well, at least in theory. I mean, building that system that actually works across borders will still need some work, and I'll get to some of this at the end. So programmability is going to be a very important use case. The other aspect, and let me spend 1 minute on this because I think this is important. We can think about the digital representation of commercial bank deposits as being one of the tokens that are actually traded in the system. Now, tokenized deposits turn out to be quite a different animal from stable coins. And let me just spend 1 minute on this because stable coins, as I said, are a very important innovation for the crypto universe. Primarily, its use case is to allow this point of contact between the conventional monetary system and the crypto universe. Tokenized deposits, on the other hand, preserves the current architecture of the monetary system in the sense that you can still have settlement on the central bank balance sheet together with the transfer across banks. Now, this is a very important theme which we think needs to be developed, and we've done a little bit of that already in the chapter. But the whole agenda for tokenization is actually a very general concept. It's not just crypto. It refers to any digital representation of claims, and it refers, and of course it builds on a whole range of legal and historical precedents. And a very good example of this would be centralized securities depositories. Now, this is the kind of infrastructure that most of us don't really, think on a daily basis, unless you're in charge of the plumbing, as it were. But it's a very, very important institution in that in the old days, if you were to buy a corporate bond, you would need to track down the paper certificate. And it's by receiving that paper certificate in your hand that that transaction is actually settled. Digital, decentralized securities depositories, what they do is they remove the need to actually have the physical paper transaction. It's given the right legal framework, it's an institution where the change in ownership is just recorded as a book entry. Now, that's a very standard system. It's an account-based system. Tokenization is simply taking that kind of digital representation and putting it, if you want, on a blockchain. Otherwise, you could put it on a centralized system. And with this, you can expand the universe of contractual outcomes. So like the payment versus payment example that I gave you. So in terms of implementation theory, this would be like saying we can expand the universe of the contractual outcomes by being able to commit to actions, by actually submitting contingent actions. Now, there is a very important debate that is going on in this area, which is the extent to which you need decentralization. And it's, of course, a very different notion of decentralization. It's a very different implementation of decentralization if you opt for decentralization. We're not using private keys here. You're relying on the identities of the natural or legal persons. And so maintaining privacy turns out to be a really important precondition for decentralization. There is actually a pretty lively and large body of work that shows how that can be done. There's also a debate about the extent to which you need decentralization at all. So in the example of CLS, that's a centralized institution. It's just that,
State Department of Economics put on a farm on crypto.
actually, trusted. And so you can, expand the universe of, contractual outcomes. But there is a set of arguments that have to do with governance and common knowledge, where decentralization may actually come into its own. And a supply chain would be a very good example, where there are many, many interested parties to a particular transaction. It takes time. So there's a shipment going from, San Diego off to somewhere in Asia. You want to track that shipment, and it could be that there is a trade financing agreement, so the bank is also an interested party. At the moment, that package is tracked through in a fairly loose way. If you use a blockchain, you can actually have everyone on the same page to achieve common knowledge. So for some use cases, decentralization may be would be very beneficial. The other use case is when decentralized governance might be very important. And that's especially true when you have what I'll describe later, multi-CBDC platforms, where there's more than one CBDC in more than one currency trading on the same platform. And if you have more than one currency, you have more than one central bank. And so the governance of that kind of system very naturally would gravitate towards a more decentralized system. But technically, you wouldn't need it. It's more due to these other reasons, and this is a very lively debate at the moment. And as I said earlier, the way that decentralization would be implemented in this kind of world would be very different from crypto. It's not based on private keys hiding behind your address. The whole thing would have to be based on real world identities, not least because we're thinking of use cases that actually have real assets. So I should say real world assets, which could be financial assets as well, but it could be real world assets that are real assets, like property. Now, the way that tokenized deposits would work, and which is different from a stable coin, is that it's just a digital version of the way that payments take place currently. And the way to work is, if I'm a customer of Bank A, and I want to send you a payment, and you're a customer of Bank B, I would instruct my Bank A, say, look, I want this payment to go through. And what Bank A would do is to debit my account by the amount that's being sent plus any charges. And then Bank B would credit the account of the receiver, right? So those are, if you like, erase write functions. Now, how is the settlement taking place? Well, the settlement is taking place separately through the central bank balance sheet. That's exactly what we would do. On the central bank balance sheet, Bank A and Bank B are both customers of the central bank in that sense. And it's the central bank that actually debits the account of A and credits the account of B. So in that sense, Bank A's balance sheet is shrunk by the amount that I've sent to you. And Bank B's balance sheet has expanded by exactly that same amount. And this is not a stable coin, because the settlement is still rooted in central bank money. Now, this kind of model is exactly the model that the New York Fed has announced recently. You may have seen an announcement of the New York Fed regulated liabilities network. There is a CBDC, there is a token that lives together with the other tokenized deposits of the member central banks in the system. And the Fed would see and would actually settle these payments. Now, when would this be? So why would this be superior to a stable coin? Well, banks have complete control over which entries they erase and which entries they actually write up. So the erase write function means that you have full information and you have full control. And this is actually something that arises when you have other policy objectives very much in mind, like anti-money laundering, like know your customer rules. Of course, for libertarians, this is anathema. I think that philosophical discussion, will need to be had. I think privacy is going to be really important for us to maintain here, especially from the central bank. But the key point is that you don't need to rely on stablecoins to have a tokenization of payment. Now, the other model, which is the so-called USDF consortium model, which is the right-hand side of this, is that you may not even need a CBDC. You can settle just using the current real-time gross settlement system, like Fedwire funds in the US, where you can have you can still have the erase write way of transferring deposits, but then the settlement takes place through the standard RTGS system. And the use cases here really are quite exciting, because what it does mean is that if you can actually combine transactions that refer to the identity of individuals, or natural persons or legal persons, what it means is that you have access to the whole set of real world assets. That's very unlike crypto, where the criticism has always been, yes, it's very clever and so on, but you're mostly trading other crypto. What use is this for the real world? If you had this kind of system, you can have access to the set of financial instruments. I talked about the centralized securities depository. You can tokenize that onto a blockchain if you wish. But I think the really interesting and exciting use case will be tokenized real estate. And for those of you who have bought and sold a house, you know how involved that is. It takes 6 weeks. It's a very, very involved process, precisely because there are many, many checks that need to be made. You need to establish identities. You need to make sure that there are no other liens on the house. Make sure that the house isn't listed somewhere and it's a cultural landmark. And then, of course, as the conveyancing process proceeds, it's like that shipment that's going from San Diego to somewhere in Asia. The state of the world is changing as well. And so you need to keep track of that transaction all the time. And ultimately, when you pay to close that transaction, ideally, you would like to do that without counterparty risk. Now, on top of that, you can have a mortgage provider who would be another interested party who would want to know everything else, as well as the buyer and seller. Now, at the moment, this is still very far, because we haven't tokenized the land registry. But there is, one project that we are pursuing in the London center of the BIS Innovation Hub. It's called Project Meridian, where we're looking into what it takes, both legally and in terms of the data format, to tokenize the land registry. And if we can do that, there's nothing in principle that would stop us from putting tokenized real estate representations on the same platform as we do tokenized deposits. And just as you don't want counterparty risk when you're paying for foreign exchange, that's the kind of very wholesale transaction. Even for individuals, this would be opening up quite a bit of new functionality. And this leads to me, leads to a very important point I want to make, which is when I present stuff on CBDCs, there is a typical reaction from many informed, very well informed colleagues. That they tend to be economists, and they say, well, why do we need CBDCs? What is it about the current system that you find defective, and why do we need this? I think the better question, so I would submit that may not be the best question. I think the better question is to ask, what are the things that are not currently happening that might be feasible if you have innovation that's going to be ultimately serving the public interest. And I think if you approach the problem in that direction, from that direction, it gives you a slightly different, perspective. So imagine that we're, back in 2006, before the launch of the iPhone, and we're all using our Blackberries. And someone says, look, here's an innovation that might really be interesting and useful. And you could say, well, what's missing now that this new thing could do? I suppose we now have the benefit of hindsight of having used this now for 10, 15 years. I don't think we want to go back to the old days, or maybe you do. But so I think that's a kind of bigger issue that has to do with the debate about innovation. Now, let me just conclude with cross-border payments, because I think this is probably the area that is undergoing the most intensive study at the BIS, because one of the things we've done is to work with our partner central banks to build these cross-border platforms, so multi-currency platforms. So, I said that each monetary system is a tree, and each tree is associated with a currency. But, if you zoom out, we're talking about the forest, and in particular, the canopy of the forest, where the tree branches come together. And it's the canopy where some of the most exciting innovations are actually happening. You can think about having a multi-CBDC platform in that canopy. And typically this will be decentralized because, as I said earlier, one of the reasons why you want decentralization is the governance. It's the fact that there are checks and balances, that there's no one central party. You can build a platform. So far, it's mainly wholesale. These experiments that we've conducted are mainly between central banks and commercial banks. But of course, the next step would be to plug in the retail payments, to that, to actually sort of interlink payment systems across borders as well. But the idea would be to have a decentralized system, typically, where you have more than one currency and more than one central bank. And then you can incorporate these features, such as smart contracts that ensure payment versus delivery, payment versus payment. You can even imagine more complicated structures where if there's a transaction, if there is a securities transaction, the settlement of that securities transaction will take place in either tokenized deposits or a CBDC simultaneously, and thereby speed things up as well as remove counterparty risk. So if you like, this is the kind of vision that we put out. I think the the events. So Jim and I talked about this this presentation way back in the summer, but I think since then, what's happened in the crypto universe has really highlighted the policy issues, I think, much more acutely. And I think this is in some ways, I think a really what we feel is that this is a very compelling vision. So Jim, let me stop there.
Well, thank you so much. I've heard so many presentations. I've heard so many presentations about cryptocurrency and digital currency, and this was by far the most informed and informative, which those of us who know Hyun always expect from him. We have a few moments for discussion from the audience. Let me remind you, if you want to bring something up, please use the chat button. Let's start with Don Billings. Don, do you want to unmute yourself? I know you've got a lot of things you want to bring up here.
Yes, good morning, and thank you for that presentation. I've been following crypto with a great deal of interest for a long time, and am encouraged that thoughtful people with serious qualifications to study this are making this important distinction between crypto, which I refuse to call cryptocurrency, which now just behaves like a Ponzi scheme, and many of them are apparently dying as Ponzi schemes do, and the more serious type of utility concept of crypto and tokenization. So I was very appreciative of the presentation for that reason. I just wanted to cut to one thing that a device that was developed in the US many years ago called MERS, which I've been thinking might actually be interesting as a kind of prototype for a tokenized system for assets like real estate. It's used for mortgage loans, facilitates securitization and trading of securities without having to go to every single county and retitle the claim every time it's traded. And I wonder if you have any thought on whether that type of system might be useful as a thought experiment.
Yeah, I'm not familiar with MERS, but I think the project on tokenizing real estate, this I think is, if you like, a real test of the use case. Tokenizing the land registry is actually quite a challenging prospect, and we're learning this as we conduct these experiments. The data format is actually very different. So standardization of data format, that's going to be a very important precondition. But there's also the whole set of legal considerations that underlie this. There are questions like who actually maintains the land registry. In some countries, there is a centralized, Ministry of Land that has the land registry. That's certainly the case in Korea. And Koreans are very big sticklers for recording everything, and so we have our family registers and land registry and so on. It's just a matter of, if you like, digitizing that. That's not always the case. In many countries, including the US, the land registry is quite dispersed. So there has to be, I think, quite a bit of preliminary work that actually renders the kind of information that's in the registry more amenable to tokenization. So that's really before you even embark on the technical project. The UK tends to be a little bit more centralized, as are many other European countries. So I think different countries are starting with different, at different levels, different starting points. There are also intermediate ways of tokenization where, it's not tokenizing individual houses. So you have an address and you tokenize the land registry so that owning the token is ownership of that house that's sitting up, at that particular address. I think that would be kind of, a very thoroughgoing notion of tokenization of real estate. You can think of slightly sort of more hybrid cases, if you like. You can think of a special purpose vehicle that actually buys up some houses. You could actually own some shares in that company, or perhaps that centralized entity can also sell you the token to the house. So what that means is, if you had that kind of system, it doesn't really matter whether the land registry is dispersed or centralized. All that conveyancing in buying and selling the house has already been done, and the ownership has been transferred already to this SPV. And it's simply a matter of transferring the token to a particular individual buyer. So there are these kinds of workarounds, but that's in a way it's a less pure form of tokenization of real estate, but it could be something which is closer to being to being realized. I haven't even touched on the issue of the tokenization of mortgages and mortgage claims. When we think about the financial securities being listed and traded on a platform like this, that's going to be really part and parcel of the same kinds of interactions that I've mentioned. So there's definitely more work to be done. And I think this is where the lawyers will have to play a very important role, as well as the kind of, people who are interested in the standardization of data.
Okay, we have time for one more question, and I'm going to exercise the host's prerogative of asking it myself. I loved your expression that Bitcoin is the blue chip of the cryptocurrencies. And some people would argue, well, there is some fundamental value of Bitcoin. It provides a flow of services that it's kind of unique to be able to do, and it's fundamentally limited in supply. So apart from this Ponzi game or bubble kind of phenomenon, which is a big part of the story as you showed us, would you agree that there is some fundamental non-zero value for Bitcoin? And if so, do you have a number for it?
That's a great question, Jim. Let me answer it like this. There is currently a very lively debate going on about how we can mitigate the risks from crypto. I mean, it's very, it's very current given recent events. And broadly speaking, there are two schools of thought in how we do this. One is like, one is to say, let's not touch this. It's what Steve Cicchetti calls let it burn. Just leave it alone. Don't even, don't even bring it into the house. It's just let it burn, and just don't give it the credibility by regulating it. The other school of thought is the one that says, look, we need to, this is not going to go away. We need to regulate it by, imposing, the best regulations that we have. Now, I think it's not a black and white thing. I think there are different degrees. So, you could think about, these two schools of thought are, if you like, the containment school and the regulation school. It's not a black and white thing. You can think of, shades of gray here. You can maybe, forbid advertising, right? Why bring it into your living room and cause all this problem? You can prevent regulated institution from engaging in certain parts of this ecosystem. You could forbid initial coin offerings, which is still the case in many economies. Now, I think one of the issues with the let it burn school is that if you leave it outside the regulatory perimeter, it's not going to go away. And Jim, you've put your finger on it, which is that Bitcoin does have its uses. It's rather minority, but it does have some uses. But I would go back to what I was saying earlier. If we go back to that pure vision of crypto, and here I am including Bitcoin as part of crypto, in spite of what the maximalists say. That was a very different world if you think about it. So how many of us was running a node on the Bitcoin blockchain? It was really the preserve of a very small group of enthusiasts who really believe this stuff. I mean, and you could believe it because it conforms to your political philosophy, your libertarian philosophy about this. Maybe you value privacy a great deal. But it was not something that was going to take off because you were going to attract, selling coins to retail investors by going into their living rooms during the Super Bowl. And to that extent, yes, there will be a use. I think there will always be a use, and presumably the enthusiasts will have a value. I mean, if you collect bottle caps, you may be willing to buy and sell bottle caps, and it's not going to be zero. If you collect baseball cards, you may be willing to pay something for a rare baseball card. But I think that's the kind of activity that would result if we go back to the vision of the pure form of decentralized crypto. And in a way, I mean, that's that's not something that we should necessarily worry about, other than perhaps money laundering, perhaps, and financing of terrorism. But provided that those bases are covered, and there are ways of tracking the blockchain to do that, you shouldn't really be worried, and it wouldn't impinge on the conventional financial system. It would be very much contained. So I think the let it burn school probably is a little bit underestimating the resilience of crypto. On the other hand, I think bringing the whole thing into the house might also bring some, it's going to open the gates, and there will be consequences of that.